Welcome everybody to the Christian Super Centrelink Age Pension webinar. Peter Murphy from Christian Super, the CEO of Christian Super, I think is going to introduce the session. Peter, you might be online there, yeah?
Yeah, certainly am, Gav. How are you?
Yeah, well, thanks, Pete. Thanks for joining us.
Hearing that you're talking about Centrelink, and which is, topic for tonight.
It is, yes. Yeah, we're focusing on the basics tonight. So going through all the how to apply, how means testing works, and then the next webinar in November is more complex strategies that don't apply to everybody, but some might be interested in.
Okay, Gavin. Well, I will let you go and do what you do so well.
Thanks very much, Pete. Really appreciate you joining us.
Okay. God bless you, mate. Bye.
You too. Bye-bye. So that was Peter Murphy, the Chief Executive Officer of Christian Super, just introing the session and praying for us there. As he said, Nathan Buttigieg, the Chief Member Officer, has been introing most of the sessions this year, so that's the different face for this particular session, and I appreciate that, Peter. Just before we get into the main content, it is important to understand that tonight's webinar is advice of a general nature only. It's please take it as that, and if seek personal financial advice if you but before making any financial decisions. That's the crux of the disclaimer there. If you do want specific financial advice, the way that we can assist you doing that is we generally ask you to complete a questionnaire. Then we meet with you for an initial consultation where we try to understand your goals, what your current circumstances are, and then talk through the pros and cons of the range of options. If it's warranted, then we can prepare specific advice for you, and we need to provide that in writing. We present that to you at another meeting. We can also help you implement it and provide ongoing advice as well. So that's how we assist in terms of giving specific advice if you need or would like that. In terms of where we're at in our webinars, so we've conducted a number of webinars and moved to a monthly schedule rather than every second month. The last couple of webinars that we did were, or last three webinars were focused on retirement planning. So if these are important to you, the three webinars that you can access either via the Cornerstone Wealth website at /retire 2015 for the first one, which is all about some of the soft things about retirement, the emotions of retirement and how much you need for retirement, phases of retirement. The second one, which was all about the transition to retirement and the financial benefits of that, that's available at TTR 2015. The third one, which was the last one we did, was all about capital gains tax and wealth transfer, a little bit more technical, available at CGT 2015, and they're all available at the Christian Super website, so christiansuper.com.au/member-webinars. You can also register for any upcoming webinars as well. In terms of this series, it's all about a Centrelink, and tonight's really about the basics of the Centrelink Age Pension and applying for it, and the next webinar is more detailed strategies. So if you want to get specific about some of the more technical strategies and strategies that potentially you could take advantage of in your particular circumstances, then tune in for that next webinar. So what we're covering off today is how do you qualify for the age pension, the work bonus. This is an important one that people, it's quite difficult to understand, but we'll walk through it. Claiming the pension, income and assets test, and how that works. Deeming rule changes, concession cards that are available and travelling overseas. And as I mentioned, we'll go into some more detailed strategies in the next webinar. Got a fair bit to get through, so hopefully we can get through it within the hour. So how to provide for your retirement. Generally there's three broad sources, so your own superannuation money, the government age pension, which we're going to focus on tonight, and then your own savings as well. So we're really focusing on the means tested age pension tonight. The key eligibility criteria is your age, and so for men born prior to the 1st of July 1952, the qualifying age is 65. For women born prior to 1st of July 1952, the qualifying age is determined by your birth date, and from 1st of July 2017, the age pension age is progressively going up to 60, from 65 to 67. And so if you look at this table here, you're able to pick your particular birth date and then determine what your age pension age is. So this is the age at which you are eligible for the age pension. So once you're of age pension age, then you're eligible for the pension. Whether you receive a pension is then based on a means test of either your income and assets, and depending on what they how they play out or what assets you have, you will either be eligible or not for the age pension. In terms of other qualifications for the age pension, it's not dependent on you retiring. It's actually dependent on your age, as we've just talked about, and your resident status. So you need to be a resident of Australia, and you need to be a qualifying resident for at least a 10-year period. Now, there are some international agreements, but generally it's a 10-year residency requirement. That doesn't need to be a 10-year block, a single block, but it can be various periods making up 10 years, but there needs to be at least a 5-year period in there to be eligible for the age pension. So there is a residency requirement. It's not a requirement to actually retire. You can keep on working. As this slide articulates, that you don't have to retire at age pension age. You can keep on working. You can scale back your work and or potentially work intermittently, or you can fully retire. So there is an age pension age, but don't see that as the time that you need to cease work. We're actually seeing an increasing proportion of people enjoying what they call the portfolio lifestyle, where they're doing some either intermittent work or part-time work, and being able to do the travel and family and other activities that they're wanting to, and finding that actually a nice period of time. In terms of the work bonus, so assuming that you're of age pension age, your income and assets satisfy the requirements to receive at least a part age pension, there is what we call a work bonus that's encouraging people who are of age pension age to continue to work. And so what they've done there is to disregard the first $250 per fortnight of earnings from employment purposes. And if you earn up to $250 per fortnight, it won't affect your age pension. Now, it's a little bit tricky trying to explain how that works, but it's probably best with an example. So we've got Margot, who earns $1,300 per fortnight. Now, of this, $250 is disregarded. So in terms of the income test, only $1,050 per fortnight is assessed under that income test. So you can effectively earn $6,500 per annum, and it won't affect your age pension. And so that's the optimal amount to work, as into working in. If you want to maximise your pension by not earning more and reducing your age pension, that's an optimal amount. But it also depends on your assets, because you could actually earn more than that, and because you are asset tested rather than income tested, you could actually earn more than that $6,500 per annum and still not affect your age pension. We'll go into an example of that later on the session. Someone's just put their hand up. If you do have a question, just put it in the chat section, and then I'll answer it or respond to it that way, rather than putting your hand up. The work the work bonus is effectively accumulates a balance. So, say for example, you haven't utilised that work balance because that work bonus because you haven't worked. You can accumulate a balance up to a maximum of $6,500, and then if you earn $6,500 in 1 week, it still wouldn't affect your age pension. So let's look at an example. In this case, Margot's, and this is a key that's a little bit tricky to try and communicate, but effectively Margot's work balance is $500. So that means effectively she hasn't worked for 4 weeks, $250 for 2 fortnights. She's earned no money, which means she's accumulated a work bonus of $500. She then returns to work and earns $1,000 in 1 fortnight. So how that is tested from an income test perspective is that the $1,000 income is reduced by $250 for the current fortnight that she's in, and then she's got the work bonus balance of $500 that also reduces the $1,000. So therefore she's only income tested or income assessed for that fortnight for $250. So if her pension was to reduce, then it would be only reduced for that ratio. And it's reduced by 50 cents. We'll go into it later on, but it's reduced by 50 cents per fortnight for every dollar over the minimum threshold, which is different depending on whether you're a couple or a single. We'll go into it later on. The other thing to understand with the work bonus is that it's a per person balance. So if you are both eligible for the age pension, you both have that work bonus amount to factor in. So you can effectively both do it. Here's an example that probably explains it best. Jim and Doris, they earn $600 per fortnight each by delivering pamphlets in their neighbourhood. They both receive the work bonus. So they've both got their $250 that they can reduce the $600 by. So their assessable amount for Centrelink's purposes is $350 so each. So $600 less the $250 fortnightly work bonus means that $350 is assessable in that particular scenario. So it's a per person assessment. So that if you could distribute your income equally, then you could earn $13,000 and you'll know that that's not going to impact your age pension. Does the work bonus apply universally, Michael asks? Well, everybody is eligible for the work bonus, but there is a scenario, Michael, where it doesn't apply, and that's where it's not employment income. So the work bonus and it can be from business income, but only not from business income. Only where it's employment income. So where people have their own ABN, for example, and they do some contracting, because that's business income, it's not employment income. They're not eligible for the work bonus. It's a lot more complex. So where I have people on or clients on the age pension, I generally encourage them to go down the employment track if they can. But if you have a business, or as in you're not operating as a sole trader, but you're operating as a company, you can actually pay yourself a wage, and that is effectively employment income. So an example is Bill, who can take advantage of the work bonus because he's got a company structure and he can pay his earnings as a salary from that private company, but he can't receive the work bonus if he distributes profit from the company to himself. So it's an important thing to understand that it's only employment income. It can't be business income or distribution of profits, if that makes sense. Hope that answers your question there, Michael. So that's the work bonus. It did replace the pension bonus scheme. The pension bonus scheme closed in 2009. Somebody asked a question about that, so I've covered that off at the very end of the session if you're interested in the pension bonus scheme. But that was closed back in 2009. So if you weren't of pension age in 2009, then it's irrelevant to you. So how do you claim the age pension? Well, you can either call Human Services, or it's Centrelink. They've sort of changed their name, but humanservices.gov.au. You can go online there, or you can call them. And once you have triggered a claim, then that is the date at which you are claiming the age pension. You then need to complete the forms, and then you need to lodge the forms within 14 days. So if I just click on, I'll see if we can actually go to the website. You can do it online. I've done it a couple of times with people online, and it's not. It's a bit of a long, slow process online, and sometimes it's simpler just to fill out paper-based forms. But it depends on what you like, whether you prefer to go the technical track or whether you prefer paper-based forms. But so here's a Human Services website. Just type in age pension. Actually, most of the information that I'm presenting tonight is available in some format on the on this website. So if you just search on age pension, for example, then it takes you to the website. Click on claiming. You just need to read through the details of what you want to claim, and then the details that you need to consider before you process a claim, and then it walks through the claiming options. So if you've already got a MyGov account, you can just log on to that account and claim. If you don't have a MyGov account, you can just register with Centrelink, or if you're unable to claim online, then you just call 132300 and you're able to then that call actually triggers the claim, and you've got 14 days to then get your documents in, and that date would be the date, if you were eligible at that date, that is the date at which you would be paid from. So hopefully that makes sense. Now, you can actually do all of the application process in terms of all the forms without going into Centrelink, but there is a requirement to prove your identity, and that's the time that it's the one and only time really that you is probably easier to go into the Centrelink office to prove your identity, and rather than have to post all you can actually post all your documents in, but if you're posting your passport into Centrelink, not many people are really comfortable with doing that. They'd prefer to just take them into the office, have them verified, and then take them away without having to hand your identification documents over. They've just changed the process actually, and they've created a new form, this SS231, and this is the first page of the form, but there are three if you look at this section here, there is a commencement identity document that you need, a primary use in community document, and a secondary use in community document. This is a slightly different process to which they've done in the past. So if you check out this form, you'll just see that you need to have one document from each of those three areas to prove your identity, take it into Centrelink, have it verified, and then you really don't need to go into the Centrelink office again. If you don't have all your documents together, just this in red section here, don't delay returning them if you don't have all your documents together. Get the documents that you have done into Centrelink, and then it won't delay your claim. If they need further information, they'll ask you for it. But particularly if you're eligible as at the date that you process the claim, don't delay getting in your documents, because they'll just ask for more information if you haven't submitted everything. Now, in terms of the time frame at which you can apply for the age pension, you can apply up to 13 weeks prior to your eligibility age, so your age pension age. But what happens if you do it 13 weeks out is that they process it, they reject it because you're not eligible yet, and then they set a reminder to actually reapply you for the pension closer to it. So generally it's better off doing it within 4 weeks of your eligibility date, and then they don't go through that process of you've been rejected and then we'll have to resubmit it again. So 4 weeks prior to the age pension age pension eligibility date is generally the time at which you should apply. Pension payments are regular. Generally people receive fortnightly pension payments in arrears. It's randomly selected based on the day that you apply, as in which day you'll be paid, but you can actually change the day to suit you. So if you prefer to be paid on Thursdays, you can change it to that date. Generally, it's directly deposited into your financial institution, but you can actually use CenterPay, which often it's just some legitimate organisations set up so that they deduct money directly from your pension account, but sometimes it's the likes of a radio rentals and those types of organisations that are wanting to take advantage of getting payments directly to it, which aren't always the best outcome for members. But you can have bills paid out of it directly, but generally it's best to get it deposited into your financial institution. The pension rate components are based on a base pension amount. There's also then a pension supplement, a clean energy supplement. If you are not a homeowner, you may also get a rental assistance. And then if you live in a remote area, there might be an allowance there as well. So they're the 5 components of your age pension. In terms of how much you will get, it's the maximum rates are currently for a single $867 per fortnight, or that's just over $22,500 per annum. And for a couple, if you're both eligible, then it's $653.50 per fortnight, or just under $1,700 per annum. So combined, I guess that's just under $34,000 per annum for a couple. Now, that includes both the base pension supplement and clean energy supplement. It doesn't include rental assistance and the remote area allowance. So that's the maximum you could possibly be eligible for, but that will be reduced based on either your income or your assets. So you start off as a single as eligible for $22,500, or as a couple nearly $34,000, and then that reduces based on a test of your assets or your income. Whichever test, the income or assets test, that provides the lower pension is what you'll be tested under. So if the income test is provides a lower pension to you, then that's what you'll fall under. If the assets test is lower, then that's the one that will be applied. It's always the lower rate that applies. But your circumstances may change over time. So you might not be eligible now, but you might be eligible later, or you might move from being income tested if one spouse is working and the other's not, to being asset tested when that spouse retires. So your circumstances can change over time. And even if you are not eligible now, your circumstances might change in the future and you might become eligible. The classic example there was during the GFC, and people's assets or superannuation balances fell, and that meant that more people were eligible for more age pension, and so that sort of scenario can actually occur. So how does the income test work? For a single person, you can receive the full age pension if your fortnightly income is less than $162 per fortnight, or $4,212 per annum. So if your income is less than that, then you receive the full age pension. If your income is over that amount, then your fortnightly pension reduces for for 50 cents for every $1 over the $162 per fortnight. To the point that if your income is over $1,896 per fortnight, you'll get no pension. You'll be excluded from the age pension. So your full pension under $162 per fortnight, no pension if you're over $1,896 per fortnight, or just under $50,000. Slightly different rates for a couple. So based on combined income, the maximum rate, if assessed under the income test, is $288. So you get the full age pension if your combined income is less than $288 per fortnight, or $7,408 per annum. And then each person's pension is reduced by 25 cents for every dollar over this fortnightly amount, to the point that if you earn over $75,452 per annum, then you'll get no age pension. Now, this can change. So, and it's assessed on a fortnightly calculation. So, if you are working casually, for example, and one fortnight you might earn $4,000, you'll get no age pension that fortnight. But the next month you might earn nothing, and then you'll get, potentially, if you're still under the total per annum figure, you'll get the full age pension. So it really depends on your fortnightly amount that you are earning as to how much you will be paid in terms of age pension payments. So there are the thresholds in terms of income. What does income include? Well, it's gross earnings from employment, including any salary sacrifice amount. So you can't salary sacrifice part of your income to superannuation and think that therefore you'll be eligible for, or you reduce your income and therefore be eligible for a larger age pension. It doesn't work like that. Salary sacrifice is included in it. The work bonus, as we've discussed earlier, is deducted if you're eligible for it. Overseas income is included. Income streams and superannuation pensions are included. Depending on whether you started that and were eligible for an age pension prior to the 1st of July 2015, 1st of January, 2015, then how it's tested varies, but we'll talk about that later on. Any rent from real estate is included in your income. Farm or business income is included, and then deemed income from financial assets is included in your income. So you need to factor all those things into your income. In terms of deeming, what that means is that your financial assets like cash, shares, bank accounts, investments, loans, now account-based pensions that were commenced after 1st of January this year, they're all assumed to earn a certain rate of return and is added to your income test. So how that's calculated is that they're all added up. Your cash, your shares, your bank accounts, your account-based pensions started after the 1st of January 2015. They're all added up. And that figure for a single person is then on the first 48,600 is assumed to earn 1.75%, and on the amount over that, it's assumed to earn $3.25%. Couples, it's slightly different. On the first 80,600, they're assumed to have earned 1.75%, and then over that figure, it's 3.25%. I'll go to an example, but someone's just got a question that they're asking. So Michael says, does the overseas income include a government pension from overseas? Now, my understanding is yes, but there are some agreements between countries. So if you're concerned about that, then it is best to speak to Centrelink directly. There is an international division that can deal with that, or often it's beneficial to speak to a financial information services officer who are sort of like financial planners within Centrelink, so they can generally help you a lot more than the person over the counter can. So just an example of deeming. So here's Brian, and he's got bank account of 4,473, and it returns. So he's getting his bank is paying him 1% return, or $44 per annum. He's got a term deposit of $72,000, earning 3%, or $2,160, and he's got shares that are generating $1,120. So the total per annum earnings on his money is $3,324, and or $169 per fortnight. Now, even though this is over the $162 per fortnight, and therefore you would think that his income, he might be income tested, because Brian's income, his actual income is not tested from Centrelink's perspective. It's the deemed income that's tested. So what Centrelink does is that they add up his total assets, multiply the 48,600 times the lower deeming rate, and then the amount over that is deemed at the 3.25%. So Centrelink only assume 103 per fortnight in earnings, so therefore he's sitting under the 162 per fortnight, and so he therefore wouldn't be income tested. He would most likely be no, he wouldn't. He'd be eligible for the full pension. Sorry, so that even though he's earning more than the threshold, because they assume a certain level of income, then he won't be affected by the income test. That's how deeming works. So that was the income testing. Now we're just going to talk about asset testing. You'll be tested under either one of these or none of them. Brian asks, does income include the fringe benefits amount many ministers get? Yes, it generally does. There are expenses, so any benefits they do. So there's a big difference, and I can provide you a document if you email me later that the Baptist Unions of New South Wales prepared, and it includes ministers generally get around 50% exempt benefits, which means they get that tax-free. So even though it's tax-free from a tax perspective, from a Centrelink's perspective, they generally include that in the assessment. But where it's a reimbursement of expenses, they don't include it. If you want to get more detail about that, Brian, then just email me and I'll forward you through that document that is quite useful. But generally, the fringe benefits are included within that test. So that's the income test. The asset test is basically testing everything that you own, and it's different for homeowners and non-homeowners. There are different thresholds. So for assets above the lower threshold, pensions are reduced by $1.50 per fortnight for every $1,000 over the threshold. Now that's going to change from the 1st of January 2017. So if you are planning on retiring and you are assuming a certain rate of pension based on current calculations, I'll provide you an example. Depending on where you sit in the income and asset, also the asset test threshold, you could be significantly it could be receiving significantly less from the 1st of January 2017 because they're going to reduce the pension at double the rate. They're moving it from $1.50 per fortnight to $3 per fortnight. I'll show you later on in the presentation about how that can affect some people depending on what your thresholds are, what your assets are. So assets that are included in the asset test are all your vehicles, boats, caravans, your household contents and personal effects, bank accounts, real estate, farms, antiques, collectibles, any money that you have gifted over the certain thresholds, and we'll talk about that later as well. In terms of valuing assets, it's the net market value. So if you own, for example, an investment property and it's worth $400 but you've got debt of $200, it will be assessed at $200,000. So it is a net market value. In terms of motor vehicles, you can use the likes of redbook.com.au that gives you valuations of vehicles. But for example, if you purchase a new car and you drive it out of the showroom, often you lose 25% of that basically as you drive it out. So you might spend $40,000 on a vehicle, but you could value it at $35,000 basically straight away. So it is your estimate of the valuation of it that you're providing to Centrelink. Now, with real estate assets, it's a current market value, and there is the Australian Valuation Office that does actually value real estate assets. So if you've got real estate other than your family home, then the value of that will be included in the assets test, and the Australian Valuation Office will actually go and value it for you. If you don't agree with that, then you can actually challenge it and have it reduced if you think it's too high, but they actually will value it for you. In terms of financial investments, it's the current value or account balance, and generally that's reasonably easy to articulate. What's not included in the assets test is your principal home and surrounding land on the same title. So if you've got two different titles, then only the one title can be excluded from the assets test. I have known scenarios where there was a block owned at the back of a property and they've moved it to a single title and gone through the trouble of doing that. But you need to make sure that it's only up to 2 hectares of under private land use test. There is, if you've got more than 2 hectares for your property, then the amount beyond that is included in the assets test. Now there is a no limit under extended land use test, where if you've been farming a property for greater than 25 years, I believe it is, that the farm, and it's been used for farming purposes for that time, then for that 25 years, then there are exemptions as well that it can be excluded from the assets test. But if that's the scenario, then I would speak to Centrelink directly and just clarify whether your farm would be included in the assets test or exempt. But generally, for most people, the home is excluded from the assets test. Assets also excluded are accommodation bonds for aged care purposes, funeral bonds, prepaid funerals, special disability trusts. It's a bit over $575,000. I think that you can, if you've got a disabled child, for example, that you can put into a special disability trust to provide for their living expenses, and that's excluded from the assets test as well. Superannuation and rollover investments up to pension age are included, until pension age are excluded. Now this is one of the strategies that we'll go through in a fair bit of detail in the next webinar, but the scenario that we're talking about here is that where there's a bit of age difference. So we've got Paul, who's 66 years of age, and Jill, who's 58 years of age. If Jill, for example, holds assets in her name in superannuation, they're not tested from Centrelink's perspective until Jill reaches her pension age. So, Paul's already eligible, for example, for the age pension. He might have been eligible at 65, and so Jill might only be eligible for the age pension when she's 67. So there's potentially 9 years that Paul could be eligible for the full age pension if they hold the majority of their assets in the accumulation phase of superannuation. So if that's the case, you've got a large age difference and one spouse is not of age pension age, tune into the next webinar. Just getting back to that change that's going to come into effect on the 1st of January 2012. Actually, a lot of people ask questions on registration for the webinar about the asset threshold. So how much assets can you have? So remember that you exclude your own home, but depending on whether you're a homeowner or a non-homeowner, there is a different threshold, and it's going to change. So if we're talking about the full age pension, you're a homeowner and you're single, the current threshold, if you have assets less than $202,000 other than your family home, then you'll get the full age pension. Now, as of the 1st of January 2017, that's going to increase to $250,000. Now, you can look at your particular scenario, whether you're single, a non-homeowner, a couple, or a homeowner, etc., and work out what the current asset threshold is for which you will receive the full age pension, and then also look at the threshold that it's going to be in the future. And the key one here to focus on is the cutout threshold. So, and this is the area that's going to have a massive impact on the 1st of Jan 2017. And sometimes these are party specific, as in the coalition is supportive of it and Labor is not supportive of it, for example, but the Labor supported this policy. So I don't think a change of government is going to actually change this particular policy. And so what the scenario is if you're say for example, a couple homeowner, you can currently have $1.15 million of assets other than your family home and still receive a part age pension. As of the 1st of January 2017, that's reducing to $823,000. So if, for example, you are currently receiving the full age pension and you've got or not the full age pension, but a significant pension because you've got $800,000 of assets and you're well under this assets test, it's going to reduce as of the 1st of January. So be careful of that. And I guess this is a lot of the questions that came through when you registered was about this. So this is, I guess, a key page to understand. Just thinking about that change on the 1st of January, they have actually announced that if you are eligible for the age pension, so say for example you're a couple homeowner, you've got $1 million worth of assets other than your family home, they have said that if that is your scenario and on the 1st of January you don't receive any more age pension because you're over the upper threshold from the 1st of Jan 2017, they said that you'll automatically receive the Commonwealth Seniors Health Card or Healthcare Card and to retain the concessional pharmaceutical benefits. So if you are thinking, I won't bother applying for the age pension because it's not worth my while, I'm not going to get it for very long because your assets are about $1 million, it may be actually worthwhile going through the process for the benefit of this Commonwealth Seniors Health Card or Healthcare Card that you will continue to get beyond the 1st of Jan 2017. Now, the age pension and on living overseas, there are a number of questions about this, and I'll come back to it in the question section at the end. But yeah, from the 1st of January 2017, again, this rule is going to change as well. Currently, if you are in receipt of the age pension and you travel overseas, after 6 weeks, you'll continue to receive the age pension, but the pension supplement will reduce, which is only a smaller amount of the full age pension. But from the 1st of January 2017, they're going to reduce that 26. And so after the 6 weeks, so currently, after the 6 weeks, you no longer receive the pension supplements, but it's a small amount. After 26 weeks, if you're still overseas, then your age pension will cut out as well, which is the larger amount generally. as of the 1st of Jan 2017, they're going to change that 26 weeks to 6 weeks. So if you're overseas after 6 weeks, not only will your pension supplement cease, but also your pension will as well. Depending on how much that is, that could be a significant amount of money. So that's changing. But how it generally works, though, is that if you are overseas and you've exceeded either the 26-week period now or the 6-week period after 1st of Jan 2017, if you have lived in Australia for 35 years between the ages of 16 and 65, which is called the Australian Working Life Residence, then you still might be fully eligible for the age pension. But if you've lived here less than that, then you might receive a pro rata amount after the 26 weeks of being overseas. There is another rule that is sometimes not mentioned, but there is also a requirement that you need to have received the age pension for 2 years in Australia before you can be eligible for this pro rata or fully eligible under the 35-year rule. So that means if you want to be fully eligible and live overseas, you need to have applied for the pension. You can only apply for the pension when you are in Australia. Generally, you need to be in Australia for 2 years, receiving the age pension, then you can move overseas, and then there's the potential, if you've satisfied these living in Australia requirements, you may be able to receive your age pension overseas for an extended period. There also are reciprocal arrangements with some countries, so you need to check that as well. Richard says, is that 6 weeks in one block or 6 weeks across several blocks over a 12-month period? It's for a single block. So it's if you're overseas for more than 6 weeks. So you could be overseas for 2 weeks and come back, and then you would not be affected. So let's look at an example of how the income and assets test interacts together. So we've got Bill and Margaret here, and they've got a home that's on less than 2 hectares, and therefore it's exempt. They've got personal assets of $10,000. Now, actually, with personal assets, so this is your home and contents. If you don't put a figure down, Centrelink assume $10,000 as the figure for your personal contents. Some people put down a larger figure because they got their assets insured for $100,000, for example, but it's fire sale value. So if you had to put all your contents out on the street and sell them tomorrow, what would you get for them? So therefore, generally you can say between $3,000 to $5,000 for that personal assets. They've got motor vehicles of $18,000, a caravan worth $4.5. They've got a holiday shack of $200,000, and bank accounts and other investments of $44,500. Allocated pension of $123,000. Total assets of $400,000, other than the family home, and there is income assumed on the bank accounts and investments of $779 per annum and $3,456 per annum for the allocated pension. Margaret's still working, Bill's retired, and so their income is assessed for Centrelink purposes at $31,970. Now, under this scenario, because Margaret's still working, they will receive under the income test $836.18 per fortnight combined. Under the assets test, they would receive $1,144 per fortnight combined, but because the income test provides the lower age pension, that's what they will receive. Now, if Margaret was to then retire, that changes the scenario. She's no longer got the $27,000 of income coming through, and therefore the income test is only $4,235, and then she switches from being income tested because to be asset tested, because that provides the lower income, lower age pension income. So that they would, in that scenario, once Margaret retires, get $1,178. But if you look at the difference, it might have been $300 per fortnight. I'm trying to do the sums there, but $300 per fortnight. She's still a lot better off being employed and earning $27,000, but she's not getting as much age pension as if she would have retired. Getting back to, for those of you who are currently receiving some form of Centrelink benefit, now it could be the age pension, or it could be New Start or the disability pension. But for those of you that were receiving one of those Centrelink benefits as at the 1st of January 2015, and they had an account-based pension that was going at that point in time, then you may... your account-based pension that you had started at that point in time may not be deemed from Centrelink's perspective, and that could be an advantage. If you're not sure whether yours is deemed or not, then you can check your Centrelink details online or call Centrelink on 132300 and find out whether your account-based pension is deemed or not. There is often an advantage in your account-based pension retaining its non-deemed status. And that's where we talk about grandfathering. So if you want to maintain that status of your account-based pension, then don't close it. Don't roll it over and don't reboot it. So maintain it in its current status, or you potentially will lose that deemed status. You also need to continue to qualify for income support. If you, for example, in 1 2-week period are not eligible for the age pension, then you'll lose the grandfathering as well. So just another to highlight that change that occurred in 1st of January 2015. If that's your scenario, it is generally handy to maintain that grandfathering so that your account-based pension is not deemed. Bit of a complex one, but just if you've got an account-based pension in place and you had it in place before the 1st of Jan 2015 and you were receiving income support, consider we really question whether you would want to close that account or change that account-based pension if it's already in place. Now, getting back to how the asset test as of the 1st of January will impact you, we had this table earlier, but if I show you an example, it will really highlight the significance of this change. So I'll do 2 examples. One is a single person, Ralph, and then we'll do a couple afterwards. So if this lines up to your scenario, it is well worth understanding. So Ralph, he's 68 years of age, he's single, he owns his own home, he's got cash of $47,000, he's got a Christian pension of $400,000, and he owns some shares of $100,000. So under the Centrelink rules, his house is excluded from the assets test, so we don't need to worry about that. But his other assets that are tested are his Christian pension. He's got cash of $47,000 and he's got shares of $100,000. So his total assessable assets under the assets test are $547,000. Now, the lower threshold, the cutout rate, is $202,000 currently. His assets over the threshold are $345,000, and therefore, at a taper rate, that was the word I was trying to look for in the intro, is $1.50 per for $1,000 over this rate, or $517.50 per fortnight. So the maximum age pension, this is using older figures. These have gone up since in the last 6 months. So his current fortnightly pension is $342.70. Now under the new rules, there's a lower threshold. So there's $250,000 proposed threshold. He's at less assets over the threshold, but he gets no pension because the taper rate has gone from $1.50 to $3, which means that he's over the upper threshold, and he'll get no pension at all. So what this means for Ralph is that whereas now he would have been receiving $8,910 per annum, he's no longer receiving that money. So he's basically taken a $9,000 pay cut, or he will take a $9,000 pay cut as of the 1st of Jan 2017. You can see the significance of this change. Just to highlight the same example for a couple, it depends on your thresholds. If you're under the lower threshold, there are some people that will go from a part age pension to a full age pension. So it depends on where you are in the asset thresholds. In this time we're talking about a couple, $800,000 home, $40,000 cash, $600,000 pensions, $100,000 in shares, houses excluded, total assets of 740, current lower threshold 286,500. They're 453,500 over that threshold. Taper rate of $1.50. Their maximum pension is 129,680. This was 6 months ago, and so they're currently getting $616 per fortnight. Under the new threshold, that'll reduce to $201 per fortnight, which means they've taken a pay cut of just under $11,000 per annum. So it's a significant amount. $11,000 per annum means that they're going to be a lot more reliant on their own resources, and therefore their assets are likely to reduce at a higher rate than they were pre-1st of Jan 2017. It's a significant change. It will have a lot of impact on people in those threshold areas. A couple of other things to mention before we finish off the main content. Sorry that I've taken a fair bit longer to get through it today, and I normally open up for questions earlier, but we're just trying to get through all the basics of the Centrelink age pension. The pension concession card, if you are in receipt of a Centrelink benefit, then you will receive the pensioner concession card. The primary entitlements are relating to discounts in health, whether that be, and generally the main thing is pharmaceuticals. So rather than paying $30 for pharmaceuticals, you might pay $5, for example. There is transport discounts, and then there's utility bill discounts, etc. Registration of your vehicle, that sort of thing. There are some informal entitlements where some clubs will provide discounts to you as well. So it's a pretty easy one. If you're receiving the age pension, you'll get this. Key one that I mentioned before, that if you are on the age pension at the 1st of Jan 2017, then come off it, you'll still retain the eligibility for this for a time. They haven't actually specified how long you'll receive this card for if you do come off the age pension, though. Commonwealth Seniors Health Card. If you're not eligible for the age pension because you've got too many assets or you're too much income, you could be eligible for the Commonwealth Seniors Healthcare Card or Health Card. This card entitles you to cheaper prescriptions, and there is a quarterly supplement that's based on the energy supplement, but for a single it's $91.34 per quarter, or a couple that's $69 each per quarter. It gets indexed up per quarter, so they always only provide a quarterly figure. The eligibility for that is based on being pension age and having a taxable or adjusted taxable income of below 52 for a single or 83,600 for a couple combined. And from the 20th of September 2014, those figures are being indexed up. There's no assets test, so you can have a significant amount of assets, but as long as your income's under this. The key change that happened on the 1st of Jan was that income streams are deemed under this rule as well. If you started a pension, there is the grandfathering that we talked about earlier. If you were receiving the Commonwealth Seniors Healthcare Card and you had a pension commenced, then it won't be deemed. The income from it won't be included in that test generally. But if you commenced a pension after that date or have gone onto the Commonwealth Seniors Healthcare Card after that date, then what you're drawing from that account-based pension will be included in those income test thresholds here. So if you're not eligible for the age pension, you still might be able to get the Commonwealth Seniors Health Card. Just one of the final topics is gifts. Some people think that I've got too many assets, I'm over the threshold, how about I just give away some of my assets to my kids or to a charitable organisation, and therefore I'll be under the thresholds and be eligible for a pension. Now, you can do that, but if you do gift over these gifting thresholds, there are deprivation rules, which mean that they'll still be an assessed asset for a 5-year period. So they're if you gift over these thresholds, it'll still stay on Centrelink's assessment for 5 years, and then it'll come off your assessment. And the amounts that you can gift each year are $10,000 per financial year, or $30,000 over a 5-year rolling period. So for a couple, that $10,000 doesn't increase, so it's $10,000 combined per financial year. So it's the same threshold for a single and a couple, $10,000 per year, or $30,000 over 5 years. If you gift more than that, then you will the amount over that will be assessed for a 5-year period. And just this last point here, it includes 5 years prior to your pension claim. So if you've claimed the pension, so if you gifted $100,000 to your kids 2 years ago and then claimed the pension, there'll be that asset will be included in your age pension assessment at the time of the assessment, and then it will stay as part of your assessment for 3 years, and then it'll drop off. You won't see it as an assessed asset for Centrelink purposes. That's how gifting works. There is a quirky scenario at the moment that if you do gift, for example, $10,000, you're likely under the current scenario to increase, if you're asset tested, you're likely to increase your income, your Centrelink age pension income by $390 per annum. Whereas currently, if you had $10,000 in the bank, it might only generate $300 per annum, and therefore you might actually net $90 per annum in the scenario. It's only because we're in this unique scenario where there's low interest rates. Where interest rates were 5%, and this was $550, then you're giving away $10,000, losing $550, but gaining $390. So we're just in a unique scenario where gifting some money under the thresholds can potentially advantage you slightly. I talked about and explained most of the going overseas and the portability. If you're permanently overseas, so I won't go into that in a lot more detail in this. I might skip over it for the sake of time because we're at 9:30 and I know it's getting late for those in the eastern states. But if you're temporary overseas and it's after a 6-week period, this is the thing. The single reduces from $1,651 to a basic amount of $574 per annum. That's the pension supplement. So that's a slight reduction in the pension supplement. Couple reduces from $2,490 to $956.80. So there's only a slight reduction on a per annum basis for being overseas longer than 6 weeks. And then if you return, then the standard rate return to Australia, then the standard rate just kicks in again. But there is that 26-week rule that we talked about earlier. That's the main content that I was going to talk through this evening. If you want further assistance, then if you need to speak to Christian Super, it's 1300 360 907 or the Christian Super website. Recordings for webinars, registration for webinars. I know most of you who registered for this webinar have actually also automatically registered for the next webinar and have likely received confirmation of that. But if you want to look at recordings, you can look at them at member-webinars on the Christian Super website, or I provided the links on my website earlier on in the session. If you want specific advice from us, then go to our website, lodge an inquiry and I'll contact you. There is a questionnaire at the end once you close the webinar. There's a questionnaire there. If you have any comments or would like me to contact you, just specify that in the comment section, or give us a call on 1300 275 428 if you want to book a consultation, for example. Now, Centrelink is a really good resource as well, so humanservices.gov.au or 132300. Just be prepared to be on hold for a while. Generally, there are long waiting times. There's also FIS. So I mentioned Financial Information Services Officers. These are really good resources to book a meeting with, and they'll help you through working out your particular scenario. There's an app, a Centrelink app, that enables you to update information on your phone or other device, which is quite good. And then if you're wanting to work out how much age pension you're going to be receiving, then there is this rate estimator as well. You can go to, I think it's, if you go to Human Services and search on rate estimator or calculator, I think you should be able to find that link there. So now I'll open to questions. If anyone's got any questions they want to ask, then please put it into the chat section. If you want to raise your hand, then feel free to do that. Otherwise, I'll just walk through the questions that you submitted when you registered for the webinar. So there's a question. I'll just step through them. It might be like 15 or 20 questions that I'm going to step through that weren't sort of covered off in the main content. But obviously, I'll make priority to those people online now and ask and answer those questions. So Michael's kicked off with, how long must I be overseas before I have to advise Centrelink? You should advise Centrelink on when you go overseas. So you should actually notify them before you go overseas. But as you'll find that Customs notifies them anyway. So if you do go overseas, they'll know about it. But you're supposed to advise them prior to going overseas. It doesn't matter how long before going overseas that you advise them, but as long as you do it before advising them. There is a rule of 14 days. If your circumstances have changed within 14 days, so if your circumstances have changed, you need to update Centrelink within 14 days of the change. And so a change in assets, for example, they say is a $2,000 change. If you're getting paid $2,000 and you're just being, a fortnight, and you're basically using that money to live on, you don't have to advise of that change. But if you've liquidated investments and put that money into your account and it's worth $10,000, then you should advise them of that change, that one asset is sold and it's now a different asset. Yeah, 14 days is the rule there. So keep your questions coming through. I'll keep answering them. If you keep asking them through the chat section there. A number of you have got your hands up. So Keith, Martin, Noel, you've got your hands up. If you want me to open your line, then keep your hands up. If you don't want me to open your line to ask a verbal question, so if you do want me to open a line, keep your hand up. If you don't, then put your hand down. So I think we've got a couple. So Martin, you've left your hand up. If you want me to open your line for a question, then leave it up. I'll just answer this question. If Martin, your hand's still up, then I'll open the line for you to ask a verbal question. It's always more interesting to do a verbal question, so enjoy that. I enjoy that if you do want to ask a verbal question. So there was one question from somebody that was, does a DVA compensation payment paid fortnightly for life get counted as an income for Centrelink purposes? I didn't mention names here, as you requested not to mention names. It is likely that it is. I think compensation payments do, but it's probably worthwhile just checking with Centrelink. If it's paid for life, I would suggest that it would. But check with, if you're receiving a Department of Veteran Affairs compensation payment, you're likely going to be receiving a Department of Veteran Affairs payment instead of Centrelink. So they will be aware of it anyway. But contact either DVA, Department of Veteran Affairs, or Centrelink, and just clarify that to make sure. So Martin, you've still got your hand up, so I'll try opening your line to see if you want to ask a question. Your line's open, Martin, if you want to ask a question.
Gavin, thanks. Can you hear me?
I certainly can.
Yeah. Just to clarify something, if I qualify for a pension and my wife doesn't because she hasn't reached pensionable age, just to clarify, all other things being equal, do I claim for the couple rate or the single rate?
Yeah, so what happens there is that your full assets and income are assessed combined and then effectively divided in half for the assessment purposes. And so what you're applying for the age pension, but the maximum rate that you will be able to apply for is the couple's rate. So rather than potentially being eligible for the $22,500 mark, your maximum age pension will be the just under $17,000 mark. It's half a couple's rate. So it's one person in the couple's rate. Does that answer your question?
Yeah, it does. Thank you very much. Appreciate that.
Yeah, my pleasure. Thanks for asking a verbal one. It's always more interesting to do those. So appreciate that.
Thanks, Gavin.
Cheers.
Bye for now.
Bye-bye. So thanks, Martin. That's great to have that question. Anyone else who wants to ask a verbal question, please just put up your hand and I'll open your line. We can ask a question that way. I'll just continue to plough through those other questions that were asked on registration. Ian asked on registration, is there a graph or equation that enables me to optimise total dollar per hour of working at my business while receiving part pension payments? Basically, I want to be able to cut back my business and still live comfortably. Thanks. Also, should I transfer my assets to your fund? I'm assuming to Christian Super. It's well worthwhile trying to do the sum. So there are calculators either on Centrelink site that you can fiddle with. I'll try to go back and see whether I can point that out for you, Ian. So if I just go to... Yeah, so here's the rates estimator. Now, compare your payment rates. So we're trying to... So, for example, he's trying to estimate payment rates for Centrelink. One way to try and work this out is to use this calculator and then change your rates and see how there's... You've got to go through a whole process of disclaimers, etc. But then you can put in all your details. Do you have a partner? Then you go and put in all your assets, etc. It'll estimate your pension. You can then adjust those figures to see how they will change based on... And you can jiggle it around. There's not a clear way of trying to optimize that, but the other way you can go through is look at the actual way that the income is reduced. So if you are both eligible for the age pension, so both people in a couple, your pension is reduced by 25 cents for every each for every dollar over the lower threshold. I think it was $288 per fortnight. So you can just do the calculations yourself and work out, well, this is what I want to live on. To make up that money, I can either work X amount or I can work Y amount, and then you should be able to come up with the figure of the optimal amount for you to work to satisfy your requirements. In terms of whether you should roll over to Christian Super or not, Ian, the things to assess, the key difference about Christian Super is that they invest in line with biblical values. So they're screening out investments that aren't in line with Christian values, and they're also putting in investments that are in line with Christian values. So they've got both a positive and negative screen on their investments, and that's the key difference between Christian Super and other funds. So if that is important to you, then Christian Super is one of the few funds that enables you to do that. Then the other thing you can check is returns versus the risk that you're taking and the fee. So if you want to compare your fund to Christian Super to your fund, they're the things to cover off. There was an article that I'm sure would be available via the Christian Super websites that I wrote about how do you compare my fund with Christian Super or Christian Super with some other fund, and it's assessing the risk of the investment options, the relative returns, and the costs, and then the main point being do you want to invest in line with your values? So you can assess it on that basis. Van and Hazel. Just saying that they have to leave. Is that okay? Of course, yeah, you can leave whenever you like. I'll just continue on. I'll send through a copy of the webinar or recording of the webinars when they become available. I'll try to get them done within within a couple of days. Sometimes there are hiccups, but I at least get the full recording available within a week, and then I do a more detailed recording where I cut up each individual segment so you can sort of jump to whichever segment you're interested in. But thanks, Van and Hazel, for joining us. And yeah, sure, you can leave whenever you like. No need to hang around at all. Do put your hand up if you do want to ask a verbal question. Linton asks, I'm 64 years old and turning 65 next September. At the moment, I'm a pastor on a reduced income due to me also having a carer's pension, which is tax-free. I was thinking of continuing on as a pastor for probably another 1 or 2 years, as my wife, who is also paid as a pastor, has a few more years before she can retire. I believe that once I return 65, though, the carer's pension will then be taxable, and am not sure what to do in regards to when I should apply for the age pension or how to structure my income if I continue. What would you suggest I do? Well, as soon as you become eligible for the age pension, that is, you turn age pension age, check what age that is based on those tables earlier on in the presentation, and then you should seriously consider applying for the age pension. If not, go and see a financial information services officer and see how your circumstances or how you can best set up your scenario to best advantage you. Because it's likely, if you're both on relatively low incomes, if you're earning less than $75,000 per annum and you've not got that many assets, you're likely to receive a part age pension, and you can receive a part age pension and carer's allowance, which I think will remain non-taxable even after 65 years of age. So check it out. But as soon as you turn age pension age, look at either applying for the age pension to test whether you will be eligible, and or go and see a financial information services officer. Kevin says, does being on long service leave at the end of my active work life still count as being in paid employment? Is there a way to receive this benefit and not affect when the pension can be received? Yes, there is. There's a couple of scenarios that, maybe I'll try and use the pen here. There's a few different scenarios that you can apply here. So option one is the example that you've suggested here. You take long service leave over time. So it's just like you're just taking your long service leave. You're still employed. You're taking long service leave. The positives of this scenario is that your 9.5% superannuation guarantee, that's what your employer pays on your income into your super fund, will be paid on your long service leave if you take it over time. If you take that money as a lump sum, so you could take your long service leave as a lump sum, then there's not the requirement to pay the 9.5% superannuation guarantee, as in they don't need to do it. But some employers choose to do it. So if your employer allows you to take your long service leave as a lump sum, but they also pay the 9.5% superannuation guarantee, that can be the best way to do it. Under this scenario, if you take it, say for example you were age pension age and you decide to take your long service leave over time, that could prevent you, depending on how much employment income you were generating each week, it's like you were still employed. So that income will be assessed from Centrelink's perspective. The positive thing about this is that you can often salary sacrifice to super this amount. So if you are receiving that money in a high income tax year, generally most long service leave these days is taxed at your marginal tax rates. So if you take it over time, you can salary sacrifice. Sometimes you are able to salary sacrifice your long service leave when it's taken in a lump sum. So sometimes you can, sometimes your employer doesn't allow you to do it. So the positives of taking it over time is that you might get your 9.5% superannuation guarantee. You might be able to salary sacrifice, but the drawback is that you're not going to get the age pension potentially, or you're going to get a reduced age pension. either no or reduced age pension. So what I find is that generally, if you are eligible for the age pension, it is most often beneficial to take the long service leave as a lump sum, particularly if you can get the 9.5% paid on top of it by your employer, and if you've got a tax issue, being able to salary sacrifice that lump sum, but it just depends on your employer. So effectively, if you go down this long service leave over time, it might prevent you from receiving the age pension until you've finished the long service leave. Under this scenario where you take a lump sum, Centrelink don't test long service leave lump sums in the income test. They'll assess it in the asset test. So the lump sum after tax is tested as an asset, but it's not income tested. So it's tested as an asset, but it's not income tested. So there's your pros and cons, not income tested, just to complete the from a Centrelink perspective. That's from a Centrelink perspective. So there are your two options. Generally, when I've done the assessment, and there are some scenarios where it's not right, it's not the right thing to take a lump sum, but most times when I've assessed it, it's better to take a lump sum if you are eligible for the age pension. Hope that's answered your question, Kevin. Phil said, thanks, Gavin. See you next week. Great, Phil. We'll see you then. Linton says, thank you. My pleasure. Keep your questions coming through if you do have questions. There's still 25 or so of us online, so thanks for staying online. But yeah, feel free to ask any questions as we go through. Richard asks about the pension bonus scheme. I mentioned this earlier in the session. So the pension bonus scheme was a tax-free lump sum for those who defer receiving the age pension because they continue to work for a minimum of 12 months. So this was basically trying to encourage people to continue to work beyond their age pension age. And it was beneficial for the government because they were not paying the age pension. It was beneficial for the person working beyond age pension age because they're generally getting more than the age pension. So they're just a little bonus for them not to take the age pension. But they stopped it and replaced it with the work bonus that I explained earlier in the session. Now, it's closed to new recipients. It was closed back on the 20th September 2009. If you were not of age pension age at that date, then you don't have to worry about it. If you were eligible for the age pension before that date and you have had satisfied, you need to work, I think it's 960 hours per year from that date. If you satisfy that work test and you were eligible for the age pension, there are sometimes some late registration provisions that might apply. So you could backdate that and potentially get up to about $40,000, I think it is, of age pension bonus. Pension bonus scheme bonus, if you were eligible. Now, if you registered for the scheme and you were of age pension age before the 20th of September 2009, and you continue to remain eligible over that period of time, you still might be eligible for the pension bonus scheme. So it depends on your particular scenario. So current members can continue to accrue the pension bonus, but the bonus depends on your eventual starting rate of age pension. So at the point in time at which you apply for the age pension, if you for some reason aren't eligible, and this might be a reason to apply for the pension bonus if you are eligible for it prior to the 1st of January 2017, once the asset test thresholds go down. So factor that in if you are, Richard, eligible for it. Yeah, review your involvement in the scheme, particularly around or before the 1st of Jan 2017. Fiona just says, many thanks. You're welcome, Fiona. Thanks for the positive feedback. Brent asks, does pension money in the bank affect the age pension? Yes, it is a financial asset. But it depends actually if you are either income or asset tested. If you're under both the income and asset test thresholds, it won't affect your age pension, but if you're over them, it will affect the age pension. So it depends on your particular scenario, but it is included in the income and assets test. Wendy asks, what happens if I don't qualify for the pension and my situation changes? Can I reapply at a later date? E.g., if I reduce my assets by purchasing a more expensive home or family home? Yes, if that's the scenario, if your scenario does change, then you can reapply. In fact, if you apply for the age pension, for example, and you are not eligible, I think you have about 9 weeks. If your circumstances change, you can then just update Centrelink and you won't have to go through the whole application process again, but they will just assess you under those new criteria, or you'll change circumstances and you might go on to it. But if that's longer than, I think, 9 weeks, then you need to reapply, go through the application process again. And similarly, if, for example, you come off the age pension because your assets go up or your income goes up, you'll come off the age pension. If your circumstances then change again within a certain period, I think it's between 9 and 16 weeks, then you can go back onto the age pension again without having to reapply. If it's longer than that period, you'll have to go through the whole application process again. Robert just signing off. Thanks again for joining us, Robert. Appreciate that. David asks, I am 63 and still working. Can my wife, who is also 63, apply for the pension as she is unemployed? No, if she's not eligible if she's not age pension age, she can't apply for the age pension, but she can apply for other benefits. That might be New Start allowance, for example, and she would have to either satisfy the activity test to access New Start, but there are actually lower tests in terms of income and assets for her to access New Start. Because you're not eligible for the age pension either, it might be difficult based on your income for her to get New Start. So potentially you won't get access to either New Start or age pension for either of you until you turn age pension age, David. This is relating to today's webinar, and I think I explained this in a bit of detail earlier on in the session, but I'll just cover it off as briefly for Philip, David and Colin, who all asked the question about, can I receive the age pension whilst I am overseas? The requirements that I mentioned earlier, and I might just flick back to that slide that related to this, because it explains, or it covers off the it covers off the topic quite well. So if you're of age pension age and living overseas, to apply for the pension, you need to be in Australia. So that's your first requirement. You need to be of age pension age. You need to be in Australia to be eligible for the age pension, eligible to apply for the age pension. Now, assuming that you're in Australia, you've applied for the age pension, you're eligible for the age pension, the next question is, if you were in Australia and receiving the age pension for 2 years, then you've satisfied the criteria to then go overseas and continue to receive the age pension if you have satisfied the living in Australia or domiciled in Australia for 35 years between the ages of 16 and 65. So if you satisfy those criteria, you could potentially be receiving the age pension on an ongoing basis whilst overseas. If you haven't satisfied those criteria, the 2 year period, for example, then after 26 weeks under the current rules, your pension will either be prorated based on the time you've spent in Australia, or it could cease altogether. I have been aware of a couple of scenarios where the 2 year period has been waived. So someone has applied for the age pension, gone to do charitable or mission type work overseas. Centrelink have then ceased their age pension because they're overseas, and then they've complained to Centrelink and said that they're doing charitable work, they've paid tax over the years. Can you please reassess that? And even though they haven't satisfied the 2 years of receiving the age pension whilst being in Australia, they've been then put onto the age pension whilst being overseas. I'm in the process of undertaking that application for a client at the moment, but I've not been successful in achieving it, but I know others have been successful in satisfying that rule or and complaining about that 2-year rule and being exempt from it. But I think in a couple of the scenarios that we talked about, it was from Philip, David and Colin. The key thing is that if you aren't in Australia, you can't apply. You need to actually be in Australia to apply. There is an international division that you can actually contact that will help you understand these matters. They'll work out whether there's a reciprocal agreement with the country that you're particularly in. But you can't be in Australia. You can't be outside of Australia and apply for the age pension. So I hope that's helped both Philip, David, and Colin in that overseas and receiving the age pension question. Nora asks, I am a dual citizen of the US and Australia. Will my social security pension impact my Australian pension? Yes, it will. It's best to speak to Centrelink, either the international department of Centrelink or a financial information services officer to see how that will impact you. Tony asks, I'm 69 and still working about 4 days a week. Am I entitled to any benefits for working past the normal retirement age? This relates to the pension bonus scheme question that I just answered. So Tony, go back to that content in the webinar or the question asked by, I think it was Richard, where we talked about the pension bonus scheme. But if you're not eligible for the pension bonus scheme, Tony, then there's no bonus for not receiving any pension benefits because you're working 4 days. But if you are earning less than, a bit under $50,000 as a single or $75,000 as a couple combined, then you might be eligible for the age pension. You should consider potentially applying for the pension even though you still are working 4 days a week. James asks, I am eligible for the pension but still working. I have drawn out my super and converted some to silver. How can I transfer the silver into a self-funded super fund, and can I do this through Christian Super? No, you can't do it through Christian Super. You can set up a self-managed super fund. You can transfer it into super, into your own self-managed super fund. I think if you can't, then you could actually effectively sell the silver and then transfer the money into the self-managed super fund and then buy it within there. I do question people transferring money into, or a lot of assets into silver and gold because they're concerned about the future. I've heard of people converting, selling their home and buying gold and silver because they think that the economy is going to collapse, and it happens on a regular basis. I hear about it on a regular basis. I do really question the strategy. You always do need somewhere to live, and so if you do own your own home, it's often best to retain your home. It is okay to have a small amount of your assets in silver or gold, but is it a massively speculative investment or gamble? Speculation, basically, what it is putting assets into silver or gold, because it is really just based on what somebody is prepared to pay for a commodity. It is not going to earn you a return. It actually costs you to hold it. So really think about that and how much of your portfolio you want to invest in the likes of commodities like silver and gold that don't actually do anything but are basically a speculative investment. Better to hold companies that are generating income through gold rather than investing in gold directly. It does have some some benefits in terms of correlation. When gold is performing, when people are when gold prices are going up, it often correlates, or is a negative correlation to the market, so generally going up. So there is some correlation benefits, but generally it's not good to have much in those sorts of investments. Hazel asks, I'm a New Zealand citizen but have lived and worked in Australia for the last 13 years. I'm now 62 years old and considering retirement. I currently work 3 days. Am I entitled to an Australian age pension? Now, I think there is a reciprocal agreement with New Zealand under the citizenship or residency rules. It looks like you've satisfied the 10-year rule. But it would be worthwhile just contacting Centrelink, either probably a financial information services officer, set up a meeting with them, assess your eligibility, and then you can start to plan longer term about how you will live post-age pension age. Alan asks, I commenced super pension 7 years ago. Is my pension fund discounted currently for the assets test? I think Alan is referring to a scheme a number of years ago whereby if you commenced what we called a term allocated pension in 2017, I can't remember the exact date, I think it was September 2017. If you commenced at a term allocated pension before that date, 50% of the asset was excluded from the assets test. I did it for a couple of clients at the time, and it has provided significant advantage since then, but it was just a unique opportunity that we're able to apply. So I think the date was the 20th of September. Don't quote me on this one, 2007. So if it's 7 years ago, it looks like that it wouldn't be this type of investment for you, Alan, but you could check with your particular fund. How it would happen is if, for example, you started the term allocated pension with $400,000, from Centrelink's perspective, they would only test 50% of it, or $200,000 for the life of that pension. So it is a bit of an advantage, particularly as of the 1st of Jan 2017, the asset test is going to reduce significantly. It's not specifically $200,000 that remains untested, but 50% of the balance. So if the balance goes down to $300,000, for example, then Centrelink would test $150,000 of that. But if you started that, if it wasn't a term allocated pension, then you know it's not discounted under the assets test. Michael asks, I am married, we own our own home. November 53 birth. I was born in November 1953, I think. Wife early 53 birth, and already on diminishing transition to retirement for family reasons. Diminishing transition to retirement, I think I understand too, you're slowly decreasing the amount of work that you're doing. I work 1 day a week and get New Start for 1 day of volunteer work. What are the bottom line figures to allow me to transition to full age pension? I think that will be age 65 and a half. Well, we could just jump back to that particular slide. So November 53 is the age. What's the age pension age? We can go back to that table that we had earlier. So just got to try and remember November 53. So Michael, November. So you're male. November 53 is within this period, so 65 and a half, yeah. So your age pension age, Michael, is 65 and a half, and therefore at that point in time, it sounds like you would be best to apply for the age pension because it's going to be higher than what the New Start allowance is. And you could continue to do your 1 day of work, 1 day of work per week, and get New Start allowance for 1 day of volunteer work. Yes, you would get a higher level of age pension. The New Start allowance is a lower rate, so it would be best for you to apply for the age pension when you when you become eligible. Robert asks, I have turned 65 and I'm still in full-time employment. When should I register with Centrelink for the purposes of the pension? It depends on what your income and assets are. You could either assess them under the figures that I showed you earlier, so those cutout rates that I showed you earlier, or and if you know that your income's over the thresholds, then there's no use applying. Or you could make an appointment with a financial information services officer, or you could apply. It's a bit of a process to go through, so I wouldn't encourage you applying if you know that your income's over. For example, 50,000 as a single or 75 as a couple. It's not worth applying because you're not going to get it. But if you are under those thresholds, then either meet with a financial information services officer or apply for the pension, and then see how you go. And that's it. That's the presentation. So if there are no further questions, I'm going to sign off there. Thank you very much for those last dozen people who have stayed online all the way through. I appreciate that, and thanks so much for joining us. I look forward to seeing you at another webinar shortly. Good night.